In the world of investing, there are a few rivalries that are just legendary, but none are quite as big or as important as the ongoing battle between value and growth. Now, these aren't just fancy terms. They are two totally different ways of thinking about how to make money in the market. So let's get right into this epic clash. Okay, so what you're looking at here is basically the story of a massive power shift. This chart tracks how value stocks have been doing, and man, for 13 long years, from 2007 all the way to late 2020, that line just kept going down and down and down. It was literally the longest losing streak for value investing since World War II. But then, look at the very end of the chart. Something just snaps. You see that huge spike? It's a massive reversal, a comeback so strong it has everyone asking the same question. Is the regime finally changing? To really wrap our heads around what's happening, we got to get to know the two main players in this drama. So, what exactly is value, and what is growth? It really all boils down to this. Value investors are basically bargain hunters. They're sifting through the market, looking for good, solid companies that everyone else has kind of overlooked or unfairly beaten down. They're trying to buy a dollar for 50 cents. On the other side, you've got growth investors. They are the futurists. They are chasing after companies with absolutely explosive potential, and they're more than willing to pay a high price today because they're betting on finding the next big thing. Okay, so keeping those two different playbooks in mind, let's rewind and look at that long decade when growth was just crushing it. They got pretty wild. The market became incredibly lopsided, and the data shows just how extreme it all was right before that big shift we just saw. Check out this chart. It shows how much money investors were willing to pay for a company's future earnings. And that top line, the one for growth stocks, it just went to the moon. This created a massive gap between value and growth, a gap that was even bigger than what we saw at the absolute peak of the 1999 dot-com bubble. I mean, think about that. Expectations had just become completely unglued from reality. And if you want a really concrete, kind of mind-blowing example of that frenzy, get this. At one point, Tesla, a company that was making less than 2% of the world's cars, was worth more than every other major car company in the developed world combined. That's just nuts. It was a sign that people weren't just betting on success. They were pricing in total global domination. And hey, it wasn't just Tesla. We saw it everywhere. Companies like Zoom shot up 6 times in value. Peloton went up 9 times. But history has a pretty stark warning for us here. Even an amazing company like Microsoft, if you were unlucky enough to buy it at the very top of the 1999 bubble, it took you 15 years just to break even. And that's the key lesson, right? No matter how exciting the story is, valuation always matters in the end. So when you see these kinds of crazy, almost chaotic swings in the market, it naturally leads to a huge question. Why? Why does this even happen? And to answer that, we have to switch gears a bit from looking at what happened to why it happened. We're going to dive into the academic hunt for a model that can make sense of all this madness. Right, this is the big one. This is the puzzle that some of the smartest people in finance have been trying to piece together for decades. Is it all just random market psychology, or are there deeper, more predictable patterns hidden underneath all the noise? The first major attempt to explain it all was a model called the Capital Asset Pricing Model, or CAPM for short. And you got to admit, it's beautiful. It's so simple. It basically says that a stock's return can be explained by just one single thing. It's beta, which is just a fancy way of saying how much it moves up and down with the rest of the market. According to CAPM, that's it. Nothing else should matter. But there was a huge problem. As elegant as the theory was, when researchers tested it with actual real-world data, it just kept falling flat. The model couldn't explain what investors were seeing with their own eyes. Certain kinds of stocks just kept outperforming what the model predicted, which meant the equation was missing something important. The fact that CAPM didn't quite work kicked off this massive search for those missing pieces of the puzzle. And that search led to the next big leap in financial modeling, a new theory built specifically to solve the riddles that CAPM couldn't. 2 big anomalies, in particular, just wouldn't go away. First was the size effect. For some reason, smaller companies consistently delivered higher returns than big companies. And second was the value effect. Stocks that looked cheap based on their accounting numbers also tended to produce higher returns. CAPM, with its single beta factor, had no explanation for either of these. So in 1992, 2 economists, Eugene Fama and Kenneth French, came along and proposed a brand new model. They said, okay, let's keep the main market factor from CAPM, but let's add 2 more factors to fix those anomalies. They added a size factor, small minus big, and a value factor, high minus low. And just like that, the 3-factor model was born, and it really felt like they'd cracked the code. And for a really long time, the Fama-French model was king. I mean, it seemed to explain how the market worked way better than anything that had come before it. But as we're about to find out, there's a final twist in this story, a hidden catch in this powerful model. Just look at this data for a second. That R-squared number is basically a report card for the model. It tells you how well it explains what's going on. The closer to 1, the better. And as you can see, in every single category, the Fama-French model gets a higher score than the old CAPM. It looks like a much better fit. Case closed, right? Well, not so fast. Here comes the twist. A researcher named Belén Blanco decided to really dig into this, and she found something pretty shocking. The model's success wasn't because it had uncovered some deep, fundamental truth about the market. It was because of how the data was being set up for the test in the first place. Think about it like this. The researchers create their test portfolios by first sorting all the stocks based on, you guessed it, their size and their value. Then they test a model that uses size and value factors to explain the results. Of course it's going to work. It's like sorting a deck of cards by color and then discovering that the red cards are all together. It's a self-fulfilling prophecy. And here is the absolute proof. The moment Blanco sorted the stocks a different way, using a totally different characteristic, like which ones paid a high dividend, the all-powerful Fama-French model suddenly broke. Those magic factors for size and value became totally useless. It proved the model wasn't a universal key to the market. It was just a key that happened to fit one very specific lock. So what's the big takeaway here? The battle between value and growth is absolutely real. You can see it in the charts. But it turns out our attempts to neatly explain it all with these elegant models might be built on shakier ground than we thought. And it leaves us with this really big, fascinating question. If even our best, most celebrated models can be a bit of an illusion, then what hidden forces are really driving the market?